What's really driving us are all of the new players in the lending industry are coming back. Old players and new players joining the industry and opening up suites of products like no income, no employment verification loans, rehab loans, stated income loans, things that we didn't have 4 or 5 years ago are adding so many more buyers to the market.
This episode brought to you by Suites at Madison. Meeting and conference rooms for rent by the hour, week, month, or year. Suites at Madison, where business gets done. Check them out at www.downtowntampaoffice.com. Now, on to the show.
You are listening to the Invest Florida Real Estate Show, covering topics in lending, buy and sell strategies, property management, hot markets, and tips and tools to guide you along the way on your path to real estate success. You want Florida investment real estate talk? You have come to the right place. And now, our hosts, Eric Odom and Steven Silverman.
Hello and welcome to another episode of the Invest Florida Real Estate Show. This is your co-host, Eric Odom, along with Steven Silverman. Steven, what's a good word?
Eric, we're heading into a good season now, and I know that you've been really busy, and so I want to ask you a little bit about. I saw you slinking around the office like with your shoulders bent over, and I could have sworn that under your coat you were carrying an axe because you were muttering about a tree, and I think it had to do with the lots that you were working on that are about to close. Maybe you can tell us a little about that.
Don't get me started on trees. Not a fan of trees. You know, it's interesting. The political climate, there's a lot of folks moving into Florida. That's a fact, and they're going to go someplace. And what's happened with inside of these cities is, and I understand you want a nice tree canopy and you want things to be nice and presentable. Trees are great. The challenge is that you had situations where there were no tree ordinances 50 years ago, and trees were built adjacent to the foundation of homes. And now you can't touch those trees because of some of the laws in some of the cities. And I actually bought a lot and split it, last year, and then spent the next 6 months with the city, arguing about, what to do about a tree. And it seems like we've got this, it's solved, and we split the lot. We close tomorrow. It's not exactly what I wanted to do, but it was an exit strategy for me. I'm not sure I would do it again, in terms of splitting a lot and trying to, I guess, speculate on it. It really wasn't an investment. It was a speculation. I thought it was something that I could do fairly well. And it came out okay, Steve. I did okay. But there were some hurdles and challenges that I learned from. And I think at the end of the day, I'm probably better suited for doing cash flow work, and will probably invest my time towards trying to find properties that produce cash flow as opposed to speculating on lot splits and holding land when we had some tense times towards the end of last quarter. We thought we might be teetering a little bit. The market might be teetering a little bit, might be heading in the opposite direction. The last thing I wanted to be doing was holding a non-cash producing, cash flow producing property with a market that downturns. So anyway, tomorrow the sun rises and, I'd be getting liquid again. So if you guys have deals for me, let me know. I'm ready to go. And if you want to participate in anything that we've got going on, I also would extend that to our listeners. If you guys are interested in investing with us on any properties, give us a call and let us know. And, we're not actually out looking for anything specific, but if you guys, feel better about, or would like to contribute to some of the things that we're working on, we're open-minded about talking to you about that. Steven, the lending market's changed a lot in the last few years.
It sure has. It's actually been a little bit like the gravity. It's been going down, which is surprising when everything else has been going up. Well, it's come up a little, but it's still a really good lending environment now. And it's time to take an overview and assess where we are and what's going on.
No doubt. The Fed is pretty dovish, and they're taking posture on the economy that they need to watch and pay attention. There's a lot of things that are happening geopolitically that make people nervous. And so as a result, the Fed has shifted their direction from being aggressive on tightening to perhaps even slightly leaning towards to loosening on the monetary side. So I think it's time for us to talk about this, because some of the programs that one of our top lenders came to us and talked about a few weeks ago, they're back to some of the old days, right? We're kind of back to where we were.
Absolutely. I mean, with a difference. I mean, they're not just giving money when you don't have any assets to support it. No,
but it's not 2013.
Skin in the game.
Yeah, but it's not 2013 either. And we're seeing some pretty aggressive programs that are rolling out. And there's really no excuse. If you're finding a property, there's a way for you to get it financed. So, let's go ahead and roll in with our guest, Stephen.
Let's do it. Today we have with us Frank Coto III. Frank is the president of the Lincoln Lending Group, which was started in 2003 by a group of real estate professionals and investors, and they built it to compete directly with larger banks in mortgages. For Frank, his claim to fame is no loan is too small or difficult to handle, and his superior customer service. His connections in the mortgage and finance and business community have led to unsurpassed knowledge of the industry and area. Today we're going to talk a little bit about lending. Frank, welcome to the Invest Florida show.
Thank you, Steve and Eric. Appreciate you. Glad to be here.
Hey, Frank, good to see you, buddy.
Good to see you.
Appreciate you spending some time with us. I know you've been fortunate to have you come to some of the meetups that we've had, and this is the first time we've had you on the show, so really appreciate it.
We had a sold-up house last time Frank was here.
Yeah, that's right. Frank packs a house. But we appreciate you coming out and talking with us for the podcast today.
Absolutely. Anytime.
Things have changed a lot. I mean, wasn't that long ago you and I were talking about the conservative lending practices, and it seems like maybe the foot has been taken off the brake somewhat.
That's right, Eric. Yeah, the foot has definitely been taken off the brake. I would almost venture to say it's been put on the gas at this point when it comes to lending programs and options available to your everyday consumer and investor.
Well, let's talk a little bit about 30,000-foot market then.
Right. Well, so first of all, one of the things, you're a mortgage broker, so you have the advantage of, an investor and it goes into a bank, they get one perspective, but you're looking at a much broader market and a suite of options. So you probably see a wider landscape.
That's right, Steve. So the difference in a wholesale mortgage broker and a bank is your bank is going to have one suite of products. You walk into the bank, you have A, B, or C to choose from. If something hits the fan and it doesn't work out, there's no DEF. There's no switching it without literally picking up everything that you've brought the bank and starting all over, going to another bank. The beauty of us is we have about 20 different lenders / investors right now that we're going to look at your client and figure out what fits them the best, and we're going to make a choice. And if something goes wrong, we simply learn from that decision or what went wrong, and we repackage it and bring it to another one of our investors and maybe present it in a different light in order to get approved the second time without making the client start over.
So talk to us a little bit about the market. Like, where are we in the cycle? What are you seeing out there? What may be some changes over the past 4 to 5 years in the market?
Sure. So the market overall is extremely strong. I mean, I think we live in paradise. If you live anywhere in Florida, you know that I think it's 500 people are moving to the Central Florida area per day right now. Our growth is spectacular. The economy's good. Frankly, I don't know why rates are so low right now. I don't think they should be as low as they are. I think if you're on the fence, it's time to get off the fence and lock something in immediately before they change. When it comes to investors, values are up. There are still some deals out there. And even though the values are up, the loan programs, like I said, putting the foot on the gas, the loan programs are more abundant now and looser than they ever had been. Not loose in a point where you have to worry about a decline or a crash, in my opinion, because we still require skin in the game. And that was the problem we had 20 years ago when I first got in the business, is we didn't ask for skin in the game, and we were lending people money with no down payment on these risky products.
Mm-hmm. Mm-hmm. So I know you talked to us just a few weeks ago. You'd mentioned that you'd expected rates to increase this year, and I guess they did, and now they've come back a little bit, and so your activity's picking up again.
Yeah, activity's picking up for a couple reasons. It's definitely for the rates being low. Again, I'm not sure why they're staying this low. When I look at all the market factors, I think they should be about a point higher. So I'm still keeping a prediction that by the end of the year, conventional rates should be a point higher than they are today. But what's really driving us are all of the new players in the lending industry are coming back, old players and new players joining the industry and opening up suites of products like no income, no employment employment verification loans, rehab loans, stated income loans, things that we didn't have 4 or 5 years ago are adding so many more buyers to the market.
So if I'm an investor and I find a new property and I come home and I put a contract on them, I'm all excited. But now comes the second problem. How do I find a loan? So is there a methodology, or how does an investor go about finding the best loan for his property?
You know, I love your scenario. Here's why. That's what 90% of people do. They find the property and then they figure out how they're going to get qualified for it. The right thing to do is try to get qualified first and then find the property. But let's stick with the real world scenario. So we have to figure out how you're going to qualify for this investment purchase that you've just put under contract. We'll start by pretending that it's a residential investment. We define residential by anything 4 units or less. Anything 5 units or more would be commercial. So you're going to buy a residential property. The first question is, what's the property look like? Is it in good shape, or is it something that needs rehab? What do you think?
It's definitely going to need rehab.
Okay, everybody, you're right, because there's not a good deal out there
that
doesn't need some lipstick on the pig, right? Okay, so it needs rehab. Let's pretend like you have great credit, or at least good credit, and you have enough income and assets to show me that we can show your tax returns and whatnot. I'm going to select a conventional rehab loan for you. And just a year ago, Fannie Mae did not offer conventional rehab financing. They only gave you loans on properties that were in perfect condition. Well, now we have products with your good credit and your good income that we can give you almost all the money. You're going to have to put down 20% of the total of the price of the house and the rehab. So if the house is $100,000, and let's say the rehab's going to be $100,000, that's $200,000. All I want is 20% down of $200,000, and you're covered. So we're basically giving you all the money for the house and 60 out of 100 of your rehab.
And what about the term of the loan? Like, if a flipper by definition is not going to hold it for long.
Right.
So how do they feel about that?
So there's not a prepayment penalty on any conventional loans, but they do ask that you pay the mortgage for 6 months. So if you're a flipper and you're not going to keep that mortgage for 6 months, you need to let us know up front, and we have some alternative ways to do the financing for you. There's some other ways to get around the rule, let's say, or do a different type of product that doesn't have any type of requirements. But in general, we'd want you to pay it for 6 months. But if it's a straight flip, we have another product for you altogether.
So let's talk a little bit about the best case scenario here. It's a good deal. It's verifiable income. The investor has a nice chunk of change to put down. Where are you going to recommend that folks go?
That one's going to be conventional. Your interest rates are going to be in the high 4s to low 5s, depending on your credit score. You're going to be out of pocket 20%. You can do a 30-year fixed mortgage. You can do a 15, a 20. That only caveat to that one is we really want you to make 6 payments.
Okay. And what about you can still, that's Fannie Mae, right?
That's Fannie Mae, conventional, right.
And just, you mentioned Fannie Mae. I'm sure that there's going to be somebody listening to the podcast who's not quite sure what Fannie Mae is. Could you just...
Fannie Mae is it's the government sponsored lending institution. It's considered conventional financing. You have Fannie Mae, Ginnie Mae, Freddie Mac. Those are all the government insured lending institutions. And basically what that means to a consumer is you're going to get the lowest interest rates for the longest terms with the lowest cost. Let me bring that up too, because conventional and Fannie Mae loans, we don't normally have to charge buyers points. We can get paid by our wholesale investors. As compared to private money or subprime financing, you're going to have to pay points. So Fannie Mae to a consumer, if you can qualify, is going to get you the best terms, the best rates, and the least amount of money out of pocket. But you need to have good credit and income.
So let's say that you've got somebody who's got good income, a good credit, and he's got the individual's found a good deal, but it's a little rough. What's the program for that?
That one can still go Fannie Mae. If the property's rough, we can do the investment loan. But let's say you're going to buy it and you're going to sell it. You're going to flip it in just a couple months, maybe 2 or 3 months. If we're going to do that, we either need to structure your Fannie Mae loan in a specific manner, which there are ways to do it, or we're going to do what's called non-QM or subprime financing or private money financing. If it's a very short-term loan, believe it or not, we love short-term loans. I like giving a guy a loan to turn something around in under 30 days, where private money is going to have a higher cost and a higher rate. But honestly, the rate doesn't mean anything, Eric, because you're not going to pay the rate for more than a month or two.
Right.
Cost, if it takes money to make money, right? If you're going to turn a house around in 30 days and make a $30,000 profit, you're probably going to pay some points. And I'd probably recommend private money at that point. Other benefit to private money is there's very little underwriting. We don't really care about you. I hate to say it like that. We care about the property. I just want the property to be worth what you're paying for it. And you're going to have to put a bigger down payment.
So what kind of rates are we talking about on the Fannie Mae products?
Fannie Mae products, you're going to be from the mid 4s to the mid 5s.
Okay.
Say somewhere in that range, mid 4s to the mid 5s. And again, you're not going to pay any points. You might pay an underwriting fee or, an admin fee, something like that, but you're not going to pay any junk fees on Fannie Mae.
And obviously we're doing this program mid 2019. If somebody listens to this 6 months from now, what would they use for pegging that rate? Is there some sort of spread over like the 10-year or spread over LIBOR, or if people want to try to benchmark that for say 2020, 2021, what's generally, obviously spreads will increase and decrease, but what generally can they use as a benchmark?
I would, simple as this, I would Google Fannie Mae investor interest rates.
Okay.
That's what I would do. The Fannie Mae, it isn't tied to the LIBOR per se. It is tied to the bond market. But the bond market is too volatile for me to tell you one way or the other. I think we're going to be a point higher in a year from now. But the easiest thing to do is just Google conventional investment rates.
And where are you seeing private money these days? You said it's a range.
Right. So private money for the interest rate, it's generally higher. We look at private money as how long you're going to keep the mortgage. It makes a difference on what you're going to do with the interest rate. So a guy who's going to flip, I'd rather make my money by charging the guy points. I'll give him 7% interest because the interest really doesn't matter to me,
Sure.
but it doesn't matter to him either. We're going to make our money in the points. But a guy who's going to keep the property, let's say for 3 years, he wants to do a short-term buy and hold. The interest rate's probably going to be 10 to 12%. Interest only. That's a key term for private money is we don't want to amortize your money. I don't want to go through the headache as a lender to do the amortization schedule. And frankly, we don't make as much money when you do that. So it's interest only. You only pay us the interest. Quick math for an investor at 12%, whatever your loan amount is, move the decimal point a couple notches, and that's going to be your payment. So if you borrow $100,000 at 12%, the payment's $1,000 a month. If you borrow $50,000, it's $500 a month. Easy math.
Okay. Now, we're kind of walking through the scenarios here. Good deal, good property, good income, good credit. And we've talked about what if the property's not in great condition and you still be able to put them into a Fannie Mae. What about if we'll take another step and say the income's not that great or you can't prove it? I mean, a lot of our investors have good income, but it's hard to prove because their job is flipping homes and it's variable in terms of what their revenue stream is. So what about that type of scenario?
Great point. Your typical full-time investor, their job is quote unquote investor, right? So they don't have a company that I can call and verify their income. We created a program about 2 years ago. I call it the 9 program. 9 stands for no income, no employment. All I want to see on the 9 program, on the no income, no employment, I'd really like to see a 660 credit score and 20% down. I don't ask for your employment verification. I don't want to ask where you work. I don't ask for your taxes, your W-2s, or pay stubs. You can close this loan in the name of an LLC, and you can borrow up to $1 million. Here's another big kicker for investors. There's no limit on the amount of properties you can buy, but they have to be residential, which means 4 units or under. Interest rates on those, probably going to be your next question. Interest rates on those are going to be, depending on your down payment and your credit, you could be as low as in the 6s or as high as in the high 7s. The last one we locked was at 7.75% on a 5-year fixed, 30-year amortization.
So you mentioned LLCs, and investors are always looking to protect their assets and working with LLCs. What are you seeing and how does that affect the kinds of loans you can get?
So you're very limited on the types of loans that you can put in the name of an LLC. For instance, Fannie Mae, conventional, FHA, all those government-backed programs, you absolutely cannot close in the name of an LLC. However, you can close in the name of a trust. And a lot of people recommend land trusts as another way to protect your assets. So that's what you can do conventionally. If you want to close in the name of an LLC, we actually allow you to open a brand new LLC with no history on it for every single transaction if you want. We almost prefer that you do that. Or you can use your existing business or an old LLC and close in that name. And that is on the program where you don't prove your income or your employment. We're going to let you close in the name of an LLC. And I recommend it. I think it's a good idea, Steve.
So in terms of the assets, like how are you defining commercial as more than 4 units residential? And do these loans apply to other types of commercial properties also?
So the commercial product we have, it's one of the best commercial products I've seen in 20 years. The commercial product, and I'll give you a couple bullet points on this one. Let's start with that's anything 5 units or over. We want 5 units to 35 units.
Residential 5 units.
Residential 5 units, right. And let's define residential 5 units because what we want are heads in beds. All right. I want to see that people can sleep there. Apartment complexes. We love assisted living facilities. Mixed use properties. What I mean by that is, like in West Chase, some of the places are commercial down below, but you have a living unit up above. We like, the attorney's offices. Now these guys are running their businesses out of there. Nobody sleeps at them, but they are single family residences that were converted into small business offices like attorney's offices. Tons of them here in downtown Tampa. As long as it can be easily converted back to heads and beds, we'll take that one as well. Again, our appetite is 5 to 35 units. If you have more units, as long as you have a low loan to value, which means a big down payment, we're going to look at that for you as well. Credit scores. Everybody asks about this on the commercial product. You can have as low as a 500 credit score on the commercial product. Now, if you have a 500 credit score, I'm going to want to see 35% down most likely. But if you have a 650 credit score, I'm only going to ask you for 25% down. Now remember, I'm not asking you for income as well. I'm assuming that the property that you own, the multifamily property or the ones with heads and beds, makes enough money to cover the debt service of the property itself. If not, why are you buying it, right?
And these are all part of the 9 program.
This is actually, it's under the same underwriter, but it's a different program. The 9 would be only for residential.
Okay.
As soon as you cross over that 5 unit mark, we're going to put you into our, we call it an ODF commercial program.
Okay. So let's keep walking down the ladder here. First we talked about not provable income. We talked about that maybe the property wasn't in the greatest shape. Let's take it one step further, and the credit's not that good. So we've got credit, property, and income. Where are you telling that person to go?
All right. So if you have a let's say really bad credit, let's say you go down to 500 credit score, and you're trying to do something that is residential with 500, because we already know we can do commercial with 500 credit. You want to do residential. We have a no document program where the rent has to cover the new loan payment. The only difference is we want a little bit bigger down payment. We're going to want 35% down. And the beauty of this program is it's about the same down payment as a private money loan, but your rate is going to be 7 to 8% compared to private money, 9 to 12%. So the benefit there is you still have a big down payment, but you're getting a lower interest rate. And that's for somebody who just has bad credit, and they really can't prove their income either. When things get really bad, let's say you really can't show me anything except for a piece of property that you can tell me is worth what you're paying for it, and it was a burned down house, or it's just terrible, and you have nothing to show. That's when you start falling into private money.
Gotcha. Okay.
Well, even private money wants to be secured, though. They want to know.
Yes.
So
that's right. You still, no matter what, on everything we're talking about, we're going to be first lien position, meaning we're going to hold a first mortgage note. So even with private money, it's a first mortgage note. Some of the cool things you can do with private money, for instance, let's say you don't really have your own money. All right. And you're going to get it from a buddy. I don't really care where you come up with the money as long as you come up with it. Let's say the seller might give you some equity. The seller might say, hey, I'll hold a second mortgage. You get me 65% of the purchase price. I'll go ahead and hold 25% on a second mortgage. Private money will let you do that. Remember, guys, private money, it's individuals making the rules. I literally get to pick and choose what I make the rules.
So in that scenario, you just said you're actually putting no money down.
Yeah, that's exactly right. If you have a seller that's going to hold a second mortgage for you, which they're out there, and there's enough equity in the property, I don't care because I'm in first lien position. And you all know from the foreclosure world that first lien position wins every time.
That's right.
We're going to get paid, not the second guy.
So we've had a lot of changes here over the last 4 to 5 years, Frank. I mean, the lending position from private and from banks and other institutional lenders have become more aggressive. Before we let you go today, are there other programs that we haven't talked about that investors need to know about?
I think the best program for an investor, in my opinion, unless they're going straight Fannie Mae and proving everything, is going to be the 9 program. By far, most investors don't want to prove their income. They want to close in an LLC. They want to buy as many properties as they can. The only caveat is you got to get a $75,000 loan. There's another program actually that we didn't mention, and it's an asset only program. But again, I can probably fit you into one of these other ones before that. That's a program where you just show me your assets, and that's good for investment or primary residence. And show me you've got the money in the bank bank to buy cash, and we're going to give you the money that you need with a 20% down payment. But overall, I would recommend the investor who doesn't want to show documentation to do the 9 program. Call us up and tell us that you want to do our investor cash flow 9 program. And that's where we're not going to ask for income or employment, just for your credit score and to show us your down payment.
And to ask a stupid question, are there any lenders anywhere that do non-recourse loans? I mean, I know insurance companies do that, but they're the only ones I know that do.
Not in mortgages that I know of. I don't know anybody who's holding a first lien position on a non-recourse loan at the top of my head. No, I don't think so. I mean, for me, I'm going to want a mortgage on anything that I do, and we lend only in the state of Florida as well. But you may find that outside the box with a private money guy or something. But you would think he's going to have some sort of collateral.
Well, that's what I was going to ask, and you just said it. You loan around the state of Florida. It doesn't really matter. Jacksonville, Miami, Naples.
Right.
Yeah. So anywhere. Why don't you tell our listeners where people might be able to find you if they want to talk to you about the Niner or some of the Fannie Mae or other loans that you have, programs you have?
Yeah, absolutely. What you're going to do, the easiest thing to do is call 813-MORTGAGE. Our funny little tagline is 813-MORTGAGE. You drop the E, we drop the fee. And that's I had to make that up, guys, because I bought the phone number and it was 8 digits long. And I didn't know when I bought the number that cell phones will ring dead if you dial 8 digits, if you go past the 7 digits. So we came up with the little phrase, you drop the E, we drop the fee, because on our conventional and Fannie Mae and FHA stuff, we don't charge people any junk fees. But 813mortgage.com is our website. You can do a free application on there anytime. It's 813mortgage.com. You can call the office, 813-319-LEND, or you can do the 813 mortgage, drop the E, drop the fee. You got to remember to drop the E. But 319-LEND, that's 813-319-LEND. Ask for myself or Beverly, and either one of us can get you some information, and we'll get you guys started. And we don't ever charge anybody for application or file reviews. I don't think it's fair to charge the upfront fees. So we're going to take care of you on that, and we're going to let you know what you can do before you spend any money.
Awesome. Frank, really appreciate the time that you came in and invested with us today. We know that your time's valuable. It's a very, very busy market in the investment market these days. And so, like I said, it's much appreciated that you come in and address our listeners.
Yeah, thank you.
Frank, we always learn from you, so thanks for stopping in. It's great to see you today.
Thanks, guys. It's a pleasure as always. I'll see you around.
And that was Frank Coto talking about mortgages and new programs that are out there for the various residential properties. And we call it residential, Stephen, because commercial means to us industrial and retail and office. And Frank's referring to commercial as anything that's more than 5 residential units. But a lot of activity going on right now, Stephen.
Yeah. And to me, the interesting takeaway I have is that Frank spends a lot of time researching, looking at the market, trying to understand what's going on. And his perspective is that interest rates are lower than they should be, and that if there's a deal out there, now's the time to lock it in and do something.
Yeah, Frank's been telling us for over a year that rates are going to be higher than they are. That people need to be engaged, and we did have a little bit of a blip back towards the end of last year, but we're back with lower rates again, and probably a dovish Fed. We're seeing a lot of aggressive programs again. There's no excuse. There's no excuse for folks. If they can find a deal, you certainly can find the money to be able to help you consummate a transaction. So Frank's a very good resource for us in helping to place some of those deals. Stephen, anything else before we let our listeners go?
Well, yes. Don't forget to go to www.investfloridashow.com. We have an archive of past shows on the website, and it's just a wealth of information, and there are more guests just like Frank.
Yeah, we've had a lot of terrific guests over the years, and I certainly appreciate you guys investing your time with us each and every week. And so until next time, hasta la vista.
You've just listened to the Invest Florida podcast with Eric Odom and Stephen Silverman. Join us every week for actionable real estate investment ideas, and of course, visit our website at www.investfloridashow.com for more shows and tips on how to earn a cash flow in the real estate market in Florida. While hosts and producers of the Invest Florida show have no reason to doubt the validity of comments of our guests, we do not warranty their accuracy. Please check with your legal, financial, and tax advisors before entering into any investment. Returns will vary from person to person and deal to deal based on unique circumstances. All information expressed in this show is for educational purposes only. Opinions of the guests are not necessarily shared by the hosts and producers of the Invest Florida show.